Over the past year, I've posted several videos explaining why I thought that real estate investment trusts were offering a once-in-a-decade investment opportunity. In short, REITs have been priced at exceptionally low valuations because we think that the market overreacted to the surge in interest rates, but we knew all along that this would only be temporary and that interest rates would return to lower levels as inflation cools down, and this would lead to an epic recovery. And now we are finally seeing it play out. The Fed cut interest rates for the first time about a month ago, and REITs surged by about 40% on average. Moreover, if you were selective, you could have earned even better returns. As an example, our biggest holding at High Yield Landlord, which is my REIT newsletter, is Essential Properties Realty Trust, and it surged by about 60%. But I think that this is still just the beginning. The Fed has cut interest rates one time, but expected to cut it again by another 50 basis points next month and another 100 to 200 basis points in 2025, and therefore I think that many REITs still offer significant upside potential. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss two once-in-a-decade REIT buying opportunities. These are REITs that have mostly missed out on the recent rally and still present significant upside potential. But before I get into it, I wanted to remind you that we recently launched a free tier to our REIT newsletter, High Yield Landlord. There we post a lot of free high-quality research on the REIT sector, including some CEO interviews. Recently we posted one with the CEO of Vichy Properties as an example. If this is the type of content that you could be interested in, make sure to check the first link in the description of this video. Leave your email there to subscribe, and it's completely free. So the first REIT I'm going to discuss here is called Vesta REIT. Its ticker symbol was a VTMX. This is the only Mexican REIT in which we are investing today. It's the only Mexican REIT that's listed on the New York Stock Exchange, and therefore it's benefiting just like American REITs from the cut in interest rates because it's raising equity in the American market and it's also borrowing debt in the American market. Therefore, cuts to interest rates in the US benefit Vesta even despite operating in Mexico. Its main focus is on industrial properties, and the interesting thing here is that most industrial REITs have strongly recovered over the past year. In fact, they have risen even more than the average of the REIT sector. However, this specific REIT, Vesta REIT, has mostly missed out on this rally, and therefore it has become very opportunistic relative to its peer group. We think that this is a great buying opportunity because there is no fundamental reason to justify this huge disparity in performance. I think that the main reason why Vesta REIT missed out on this recent rally is simply because it's not known by most investors. It's a relatively small REIT, it got listed in the US just about 1 year ago, and therefore most REIT investors simply don't know about it. It's a similar situation as Sila Realty Trust, which is a new REIT listing that we recently highlighted on this channel. It's priced today at a discount relative to most of its healthcare peers simply because investors don't know about it yet. But I think that as more investors become familiar with these companies, they will experience more buying pressure, which will lead to a higher valuation, a higher share price, because from a fundamental perspective, Vesta REIT is doing very well. This year, for instance, the company has guided to grow its FFO per share as well as its NAV per share by roughly 10%. And I expect this rapid growth to continue for a long time to come because of the growing trend of nearshoring. These days it makes a lot more sense for American, Canadian and even European companies to shift some of their supply chains from China to Mexico because it's much closer to the end consumer, which reduces the transportation time even for European companies. On top of that, the labor is a lot cheaper these days in Mexico when compared to China. And finally, perhaps most importantly, I think that the events of recent years with Russia invading Ukraine as an example has taught us that perhaps these dictatorships like Russia and China cannot be trusted. Today, China is supporting Russia in its invasion of Ukraine, is threatening itself to invade Taiwan, it's working hand in hand with the North Koreans. You know, I think it's rightfully making a lot of Western companies a bit reluctant to continue doing a lot of business in China, or at least to have significant portion of their supply chains located there. And therefore, I think that the growing trend of nearshoring will continue. More and more companies will bring back portion of their supply chains to other countries, and Mexico should be a great beneficiary from this. This should lead to a lot more demand for industrial space, specifically in Mexico, and sophisticated real estate investors know this already, and this explains why Blackstone, the leading private equity player in the world, recently attempted to buy out a Mexican industrial REIT called Terrafina. Ultimately, Prologis, which is the biggest industrial real estate investor in the world, made an even better offer for the company and it ended up acquiring it. Here's what they said in a press release. This investment comes at a unique moment for Mexico and demonstrates our long-standing commitment to one of our most important markets. These investors are long-term oriented and they know that there's a huge opportunity for industrial space in Mexico today. I expect REITs like Vesta to enjoy strong organic rent growth in the years ahead, but importantly, they're also well positioned to develop new properties, earning significant spreads over the cost of capital. Even today, you know, they can sell equity in the US market, they can raise debt in USD, and they can then redeploy that into development projects in Mexico. And so far, the initial yield has been on average over 10%. In comparison, the American peers like First Industrial, Rexford, East Group Properties typically are happy if they can get an initial yield of 6%, perhaps 7% in the best cases, while Vesta is getting closer to 10%, and yet it's also able to access debt in the American market, perhaps at slightly higher interest rates, but the spreads are much stronger in Mexico. But despite enjoying these very attractive growth prospects, Vesta REIT is today priced at a significant discount relative to its American peers because it has missed out on this recent rally. Right now its FFO multiple is about 13 times. In comparison, its American peers commonly trade at closer to 22 to 25 times in today's market. To be clear, I think that Vesta deserves to trade at a lower multiple than its American peers because these are riskier markets, the properties trade at higher cap rates. I mean, let's not lie to ourselves, Mexico is a riskier, less stable market than the US. However, what this also means is that here you have an opportunity to buy a company with faster growth prospects at a lower valuation, and therefore you have a realistic path here to earning alpha-rich returns. And if the likes of Blackstone and Prologis are developing billions of capital into this specific opportunity, then I'm happy to also participate in it by buying the discounted shares of Vesta REIT on the public American market. Note that the dividend yield is relatively low at around 3%, but this is only because it has a very low payout ratio. The REIT is retaining about 2/3 of its capital to reinvest in growth today. But if here you add a 10% growth rate, that's what they expect for this year. I think they should be able to achieve that over the next many years. You're getting to 12 to 15% average annual total returns from the yield and the growth alone. But now add to that a bit of multiple expansion, perhaps as the company becomes better known in the REIT community. You could expect some 20-30% additional upside from FFO multiple expansion, and combine all of this now together, the yield, the growth, the FFO multiple expansion, and I think that we have a realistic path here to earning 15 to 20% average annual total returns over the next 5 years to come. That's very attractive coming from a REIT, and that is why I call it a once-in-a-decade investment opportunity. The one pushback point that many investors will probably put even in the comment section below is what will happen if Trump wins the election? And I'm not going to waste too much time on this topic because I don't think that it will ultimately have any major fundamental impact on the company. Yes, Trump wants to build a wall at the border and he's also threatening trade wars with everyone, including even Mexico. However, there are strong structural economic reasons that favor Mexico for nearshoring, and those structural reasons are not going anywhere. Moreover, it's important to remember that it was under Trump's presidency that the United States-Mexico-Canada agreement was negotiated and implemented. The American and Mexican economies are today deeply interconnected, and there are significant mutual benefits here. Back when Trump won in 2016, we initially saw Mexican stocks sell off, but then they rapidly recovered once it became clear to the market that there won't be any significant fundamental impact on them. And perhaps we will see the same thing happen. If Trump wins, you might see Vesta sell off initially, but again, I don't expect any major long-term impact. I think that the growing trend of nearshoring will continue, whether they put some tariffs on Mexico or not. And again, remember also that if they put some tariffs on Mexico, there probably will be also tariffs, perhaps even greater ones, on countries like China. And therefore, ultimately, I don't expect a major impact from the election. Hey, before I go into the second company, can you please do me a huge favor and click the like button if you think that this type of content is valuable. Also subscribe if you don't want to miss similar videos in the future. Thanks so much for all your support. So the second company that I'm going to discuss now is called RioCan. Its ticker symbol is REI.UN. And this is our favorite opportunity today in the retail property sector. And retail is hot right now. It's one of the most popular property sectors of the REIT market. Retail REITs are currently commonly trading at 15 to 20 times FFO, which are historically high multiples for these REITs. There is also significant interest from private equity players. Right now it's rumored that Blackstone might be attempting to buy out a retail REIT called Retail Opportunity Investment, ticker symbol ROIC, and as a result it has surged by about 20% in recent weeks. So far, our top pick in this space has been Whitestone REIT, ticker symbol WSR. It has massively outperformed its sector peers, and right now there is also significant interest from private equity players. It has received several offers over the past year, the latest one at $15 per share, and as a result its share price has surged very significantly. Here you may wonder, why is retail suddenly so popular? Isn't it going to be impacted by e-commerce? And it really comes down to supply and demand. The demand for certain type of retail properties is growing today. Now think here about perhaps your local grocery store. That property is perhaps anchored by a grocery store, and then there are some essential services as other tenants like a dry cleaner, a barber, some restaurants. These are not the type of businesses that are impacted by e-commerce, but if these properties are located in growing markets, they enjoy growing population, there will be growing demand for this type of retail space. However, despite this growing demand, there is very little new supply of retail coming in because of this negative perception that retail will be impacted by e-commerce. And so having growing demand but not growing supply leads to a more favorable supply-demand dynamics, high occupancy rates, and growing rents. We've recently interviewed the CEO of Whitestone REIT for a REIT newsletter, High Yield Landlord. By the way, you can read it with the 2-week free trial that we're offering to new members. This will also give you access to all our other interviews and all our other portfolio holdings. But in this interview, what the CEO of Whitestone REIT said is that with very few new neighborhood shopping centers coming online, supply and demand fundamentals are translating into very strong results for most shopping center REIT peer groups. And so that's why retail is doing so well today. And another reason is that we've had high inflation in recent years. I'm sure you know about that. And these are some of the best inflation hedges in the retail property sector because leases are relatively short, their tenants are bumping up their prices, and the landlords are also able to bump up their rents quite significantly. And so right now there's a lot of demand for these REITs, and unfortunately it's getting harder and harder to find opportunities. But one REIT that has missed out on the rally is called RioCan, and that's our favorite opportunity today. It's a leading retail REIT up in Canada, and we think that from a fundamental perspective, it should have surged even higher than its American peers, and yet it has mostly missed out on this rally, and as a result, it has become deeply discounted relative to most of its American peers like Federal Realty Trust, Regency Centers, Whitestone REIT, as I mentioned earlier, and many other retail REITs. I'll put a table on the screen comparing the valuations, but you'll see there that it's today priced about 11 times FFO compared to 15 to 20 times for its American peers. A steeper discount to its NAV, a higher dividend yield, and that's despite also having typically a lower payout ratio than most of its peers. And we just think that this recent underperformance and lower valuation will result in higher returns going forward because the company is doing really well from a fundamental perspective. Its Canadian markets enjoy faster demand growth and even more limited supply, leading to very high occupancy rates and strong rent growth. There is rapid demand growth for its properties because they're located in major Canadian markets. It's earning over 50% of its rental income from Toronto. These markets are enjoying very rapid population growth. In fact, Canada today enjoying the fastest population growth of all G7 countries, and the difference is very significant. At this pace, according to some estimates, the population of Canada could reach 100 million by the end of this century, up from less than 40 million today. So that's very rapid population growth, and most of these people are moving to the big cities in which the properties of RioCan are located. But despite that, there is limited supply growth again because this is retail, which has been out of favor in recent years. But secondly, because the properties of RioCan are in prime locations of these big markets that are very dense and the best sites are already built out. Moreover, the zoning regulations are much tighter in Canada when compared to the US, so getting building permits is harder. The cost to build is also very high today, and so typically the cost to build doesn't justify the potential return, and so as a result there is very little supply coming online. This superior demand-supply dynamics also well reflected in the occupancy rates. That of RioCan is today 98.3%, whereas the occupancy rate of its American peers is 92 to 95%. You'll note here that 98.3% as an occupancy rate for a retail REIT like RioCan is truly exceptional, because typically if you reach about 95%, you'll consider that you're full already, because there's always a bit of turnover with your tenants. So it's really exceptional that they have such a high occupancy rate, and it just speaks so highly for the quality of its assets. And it's also well reflected in its rent growth. Its leasing spread about 30%. Today, its average lease has a $22 rent per square foot, yet their new leases are getting signed at closer to $27. So there's significant spread to be earned now as its leases gradually roll over the coming years, leading to significant growth for the REIT. So why is the REIT so much cheaper than its American peers? Here you may think that it's simply because it's in Canada and so it won't benefit from the Fed cutting interest rates in the US, but this is not really a valid argument, because the Central Bank of Canada is also cutting interest rates. In fact, it started cutting them even earlier than the Fed, and it's expected to cut them even more aggressively. So from that perspective, RioCan should have actually surged higher and faster than American REITs. I think that the reason why it's so cheap is because the REIT operates with somewhat more leverage than its American peers, and this is scaring some investors. Its debt to EBITDA today is about 9.2 times, and compared to its American peers, which are typically at closer to 6 times. However, it's important to keep in mind here is that the debt to EBITDA of RioCan is only so high because it has a very big development pipeline. It's building a lot of properties. This is costing its cash flow, but these properties are not generating anything yet, and so it's artificially resulting to a higher debt to EBITDA than if it didn't have any of these development projects. The company estimates that as these development projects come online, its debt to EBITDA will drop to the mid-7th, which is still higher than its peers in the US, but the difference is not that significant. Also, you should keep in mind here is that RioCan really has the top quality assets in this property sector with very high occupancy rates, strong rent growth, and when you have the prime assets, you can operate with somewhat more leverage because the assets are just lower risk in their nature. Finally, the REIT is retaining a significant portion of its cash flow. It's about 40% with its low payout ratio, and so this is allowing it now to pay off some debt organically. Therefore, I don't see the debt of RioCan as a long-term issue. Yes, it's a headwind in the near term, but the company is addressing it now by finishing its development projects, paying off some debt organically with the cash flow that it retains. And so I think that a few years from now, the market will have forgotten about this, especially as interest rates return to low levels, and then we'll see a recovery in its share price. And if it repriced at similar levels as its American peers, you could see up to 50% upside from here. While you wait, you're earning a 5.6% dividend yield despite the very low payout ratio, so that's very attractive. It's paid on a monthly basis, and so that will help me to stay patient while I wait for this upside. Even if you use more conservative assumptions here, I think that you have an easy path to 20 to 30% upside from here. Even then, the REIT will still be priced at a slight discount to our NAV estimate, also a discount to its American peers, and therefore I think that the risk reward is just very attractive here. To those of you who listened till the very end, thanks so much for all your support. I appreciate it a lot. If you could please click the like button, that will help me a lot to produce all this free content for you. Thank you very much. And once again, if you want to access the free tier of our REIT newsletter, it will be the first link in the description. There's a lot of high quality research on some of my favorite investment opportunities there, so I don't know why you wouldn't check it out. You have absolutely nothing to lose and everything to gain. Make sure to sign up with your email so you don't miss our future reports. Again, thank you for your support and see you in my next one. Bye-bye.